Let's start with the Chinese currency. 7.1, 7.2. Do you think any of these levels actually matter to policymakers?
It's a great question. For the time being, renminbi has depreciated sharply against the dollar. But when you look at the renminbi valuation against trade-weighted basket, the current level is very similar to the level at the beginning of this year. So stability of renminbi is more against the trade-weighted basket rather than the dollar. But for the time being, 720 is our near-term target. But yesterday, the central bank has reimposed macroprudential measures trying to manage the pace of depreciation. However, it doesn't seem to be effective. So we feel for the time being, perhaps the policy diversion driving the renminbi weakness will continue.
What would be effective?
I think a couple of things have to happen. Number one, China has to perhaps make changes to zero COVID strategy, especially during winter time, given Omicron is really challenging in terms of pandemic controls. So if COVID strategy is maintained as tight as it is right now, there will be further disruption to consumption, to investment, even slow down the policy impact of macro stimulus from fiscal easing, property sector easing, as well as the monetary easing. So COVID strategy changes, potential relaxation is number one. Number two, property sector recovery has to pick up. Up to August data, overall property investment continue to decelerate, and we're entering into the September-October sort of silver, golden, seasonally strong demand for the property sectors, and we will see if property sales will start to rebound.
Well, what do you think the fourth quarter looks like then? Include that long holiday, Golden Week. There's the Party Congress, and I see you expect that things will take a turn for the positive after that. Why do you think that way, and what's the fourth quarter looking like for you?
We expect continued sequential growth recovery in the fourth quarter. Domestic demand will gradually recover and be more responsive to policy easing, both in property sector as well as fiscal spending. I think will perhaps pick up momentum after the Party Congress, and that hopefully will cover up some of the slack left by the property investment slowing down. And the fourth quarter, I think perhaps external demand, export sector growth will maintain relatively robust, so that hopefully will also carry out the growth momentum. We are forecasting 4.5% year-on-year growth in the fourth quarter, and our full-year growth forecast is unchanged at 3.3% year-on-year.
Okay, if I'm looking at a rebound, or at least things looking a little bit better, what does that mean for the inflows and outflows story for bond markets, right? We're starting to see inflows come back for Chinese bonds. Does that sustain itself, and does a weaker currency impact that in any way?
That's a great question. For the time being, we expect the outflow from bond market to persist before the year ends, but the pace of outflow likely will slow down because we feel most of the carry positions trying to pick up or for yield enhancement and currency carry positions in the bond market, most of them now is out. So what's left is mostly either index tracking or asset allocation-based investors. But for the time being, we feel U.S.-China interest rate gap will remain relatively wide. Perhaps we are looking for middle of next year or even second half of next year when the policy divergence starts to reverse towards convergence, the slow convergence, meaning the Fed perhaps will pivot towards being less hawkish, and the PBOC is turning more neutral on monetary policy. I think that's when the interest gap between U.S. and China will stabilize and perhaps narrow, and that's when perhaps the inflow will resume. So for the time being, bond market inflow outlook is not very optimistic. Equity market volatility perhaps will persist, but really it's driven by overall fundamental growth recovery as well as risk sentiment recovery.
This might be a little bit more nuanced question on China. The finances of local governments and municipalities have been strained this year because of how they've dealt with COVID. And this takes us into the fiscal side of the story. And how much support really and room does China have this and next year to support the economy? I'm wondering if you have any thoughts on that.
That's a very important question. Given the constraint for monetary easing, we feel fiscal easing will play the most critical role in support growth recovery. But this year, clearly, fiscal revenue growth has been quite slow, and fiscal spending has ramped up, both for COVID-related spending as well as for infrastructure spending. We expect the fiscal deficit perhaps to rise to 7.5% for the full year, but we actually hope for incremental fiscal easing also going into next year. And that's from carrying out infrastructure spending. That's also coming from, for example, yesterday the State Council announced the auto subsidies for the EV car purchases will be maintained throughout next year. So, consumption supporting schemes as well as infrastructure spending will put more pressure on fiscal spending. And that perhaps will bring more fundraising for next year. But hopefully, if COVID restriction can be relaxed, then spending related to COVID will slow down and the economic activity will pick up. Fiscal revenue will resume growth.